My name is Aly McFarlane, and I'm a managing partner at Wealthfolio Advisors and also a fiduciary. Let's look at the Fed rate cut. We're going to take a look at a Yahoo Finance video, and I'll give you my reactions.
So what strategies should you be using to take advantage of the Fed's easing cycle? Here to help, we've got Matt Stuckey, who is the Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities. Matt, great to see you. Thanks so much for hopping on the program with us. So what are some of the pivots that people would be apt to have in mind?
Well, good morning. I think now is a really good time to revisit your financial plan goals and objectives with an advisor.
This is a really relevant thing to do because times are changing and it's always good to check in with your financial advisor. If you don't, things change. It could be a Fed rate cut. It could be the fact that you have a life change. But checking in with your advisor and making sure that you continue to be on the right path is imperative. Let's keep listening.
The attractiveness of money market funds has started to dissipate somewhat. And if the forward curve comes to fruition, if we're having this conversation a year from now, Brad, instead of earning 5.5% on your cash, which is where we were, just last week, that number's down to 3%. So there's some changing return profiles happening in the capital markets.
So let me just break this down in terms of numbers. If you're getting 5.5% on your money, you're getting $5,500. Now you're getting $3,000. So that's a $2,500 a year difference, which is more than $200 a month. So it's really important that you look at the impact of invested cash on your individual portfolios.
Advisor can start to help you migrate some of that cash into a diversified portfolio. And that's really important because if you look over a longer term horizon, 5 years, 10 years, the one asset class that tends to be towards the bottom of the return stack is cash. So sitting on excess cash does have risk.
And so with that in mind, as you're thinking of the diversified mix of a portfolio, how drastically do the percentage allocations, do you think, change post-decision as well? Whereas someone might have been looking at fixed income and their balance of equities versus fixed income, perhaps they even have some crypto, how all of these things might shift because of the decision from the Fed and the pathway forward here.
I don't think your long-term strategic asset allocation should be changing very much based on yesterday's Fed action. However,
he brings up a really good point here. Long-term is a lot different than short-term, and you have to treat them differently, but you have to deal with them concurrently. So it doesn't mean that you should pull a ripcord and suddenly change your entire portfolio. You really have to look at each individual portfolio and figure out exactly what the best thing is for that individual, aligned with their risk tolerance and their retirement needs.
We've seen is that over the last couple of years, the allocation that investors have had towards cash has risen dramatically. This is a time, I think, to revisit a longer-term strategic asset allocation and deploy that cash into your portfolio in a strategic manner.
Now, you need to be careful about what he just said there, because while you are retiring or pre-retiring, if you put some of that cash that potentially may be used for emergencies or medical or something like that, it can pose risk. I'll give you an example. Most economic cycles, recessions are anywhere from 12 to 18 months. If the market went down at the same period, you potentially could put some of those assets that you'd need to pull short term at risk. Here's an example. Let's say you had $1 million and $200,000 was in money market and $800,000 was in the market, and you decide based on what you hear here is to take that money and put it into the market. Well, the issue is if the market goes down 30%, well, that $200,000, forget about the $800,000, the $200,000 that you may be able to pull for an emergency also goes down by 30%. That's $60,000. Can you afford to have a $60,000 hit? Well, many of you can't, right? You don't want to have 30% off on the assets that you potentially may use. So your mileage may vary. You have to take a look at what your short-term income needs are, because one of the things that happens during the retirement is if you continue taking income off a declining investment, even for 12 to 18 months, it can have a substantial impact on your total long-term retirement planning needs.
One thing that we're cautioning our clients with is, they're looking to replace that 5 to 5.5% that they were getting in the money market kind of area with something that's a similar type of yield. But today you have to take more risk to achieve that. There's a lot of conversation about, can high yield bonds make sense here as a replacement to the types of yields that we were getting in the money market space. That's a very different risk.
I want to interject here for those of you who do not know. High yield is the rebranded name for junk bonds. Many people don't know that, but they're synonymous. They are the same. So when you hear high yield, it does mean junk bonds. Now, again, as I said many times before, your mileage may vary, but it's a little risky there.
There's credit risk there, and right now that credit spread is just at 3% or so. Rewind the clock 2 years ago, back when some recessionary concerns were elevated in 2022, that spread was 6% or 600 basis points. And if we were to revisit that, that's a 10% downside to the high yield asset class if that were to happen. Very different return profile and volatility profile versus a money market which doesn't move in value. So
what he's saying here is if you're going to shift your funds to a high yield equivalent and go into a high yield bond fund, you've got potentially 10% downside risk. Whereas in money market, the risk was negligible, right? So you really want to there's a big difference between having 5.5% with virtually, very, very, very limited risk to potentially 10% risk, right? So if you've got that same $200,000, what happens if you lose $20,000, right? Was it worth the switch? I don't think so.
It's a long-winded way of saying that your strategic asset allocation should not change just based on what the Fed does. And be wary of the risk that you take is when you take one money market kind of return stream and apply it to another thing like high yield.
Matt, while we have you, technology in past cutting cycles has outperformed. Is that anticipated to be one of the sectors or themes that continues to catch a bid from either the larger institutions or individual investors out there that are trying to pick and choose where they should continue to lean into themes that have done well over the past year, 18 months, or take chips off the table?
Right now we're talking about the current macroeconomic environment with our clients as being one in kind of later kind of cycle dynamics, meaning that in our view, the risk of a mild recession is still somewhat elevated. And in that sense, you want to embrace diversification, not just concentrate into what's working well. If the economy does achieve a soft landing, yeah, sure, technology could continue its current momentum, but it is a higher beta sector. And if you do...
So what he's saying here is technology is being higher beta. It means it has more volatility. So it has the ability to go up and down a little bit more. So although you can make more money on the upside, you can also lose substantially more money on the downside. So you've got to weight it and you've got to look at a diversified portfolio. Let's see what else he has to say.
You start to see the economy continue to decelerate and the labor market continue to decelerate, there is the risk that that high beta kind of profile of technology can work against you. And so I would just caution a little bit against concentrating into one specific sector of the economy. Instead, embrace things like U.S. small cap, U.S. mid cap, international equities to get diversification.
One of the things that's happened over the last couple of years is people are overweight in technology, and it has really paid off. And so portfolios have ballooned. But empirically, just because technology is done well doesn't mean it'll continue to do well. There could be a specific pullback in that sector. So it's very important that you diversify into other sectors as well to lower the volatility within your overall portfolio. Matt brought up a substantial amount of really good nuggets of information. Just remember, as you do this, it's really important to not look at just a Fed interest rate cut. You have to look at the big picture. Where are we going to be in 12 to 18 months? Where are we going to be in 10 to 12 years? You need to take a look at the big picture and see how these small changes affect your big picture. They really shouldn't. The road should be consistent, but he's talking about what to do with cash And it's a big, 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 can of worms as to what you should do with the cash, what kind of risk that you introduce if you do invest that cash, either domestically or internationally, or if you decide that you're going to go into bonds, and what kind of bonds you would go into, be it high yield or junk bonds, which he references, or short-term bonds. But you really have to take a look at the big picture. You've got to take a look at what's the best thing for you and how to balance it within your portfolio, because if you do not do it correctly, the impact can be substantial and can derail your retirement plans. My name is Aly McFarlane, and I am a financial advisor and fiduciary, and I help people every day, just like yourself, work on these specific situations. If you have a question, please click on the link below to schedule an appointment or call the number on your screen. I look forward to hearing from you.